Welcome back, ladies and gentlemen, to the BI Breakdown. And today I have with me again for like a part 2 here, Brent Kesler. So, man, thank you for being here, Brent. Man. And it's nice having you in person, of course.
Very good. I'm glad to be here.
Yeah, so for you at home that don't know, Brent is actually how I got started with becoming my own bank and what's known as the infinite banking concept. So I read the book, Mapping Out the Millionaire Mystery. Yeah. I got on the phone with you, and it was like, what's crazy is I think most people you talk to, they've seen your presentation. I didn't see your presentation at all. I just read the book, and then I got on the phone with you. Lucky enough, that's how I know things work, and everything happens for a reason because I'm here today, right? And so I read the book, and inside of that book, I had a lot of questions from it, of course. So I asked you, I probed your mind for a little bit, and then I was ready to go. I was ready to get started. And that's when you put me on to Jonah and Jeremiah on that same phone call. You was like, yeah, I can hook you up with some guys that's in your area because I saw in the book that you passed through Greenwood, South Carolina. I'm like, I'm in Greenwood, South Carolina right now. So I ended up getting connected with Jonah and Jeremiah. And like I said, that's how I know, like God works in mysterious ways is because like the chances of me getting you on the phone, then getting in touch with Jonah and Jeremiah is like, I could have got anybody, right? So that's my little story to Brent is my mentor into how I got started with infinite banking and, of course, how I met the banking bro. So, Brent, I wanted to know a little bit about, like, your banking journey. And I know, you said it before, but, like, from its inception, when you first got started with your first policy, what were some of the things that you were doing? And, like, what was your main focus? What were you trying to tackle?
Yeah, well, in the beginning, when I started my first policy, it was about paying off debt or paying down debt, right? Gotcha. So I went through that, and again, if you guys have listened to my story, I paid off almost $1 million of debt in 39 months. As time rolls on and you get all that debt paid down, now you've got all this money because you're keeping that money in your family, right? Mm-hmm. There's no money being leaked out. So now there's other opportunities, that come up that as far as that I can use my money for. And for me, a lot of it was being able to invest, take the money from the policy and invest it because I've got this stack of money. I've got lots of money. I don't owe any third-party debt, and I have extra money. So I got to put it somewhere. And, of course, as you know from my story, I don't do any 401ks. I don't do any IRAs, qualified plans, no pensions, right? I don't put anything in the stock market. I'm not into cryptocurrency and Bitcoins. I have some gold and silver, not by choice, just because I'm too lazy to sell what I have. But, so I decided to start putting money into real estate. And, if I do that, that's going to make me more money, right? Yeah. So I have this money, and I'm not going to just have it sit in the bank because the bank doesn't pay you anything. Yeah. So how can I make money on my money? So I started into real estate. I bought some long-term rentals, short-term rentals, Airbnbs, VRBOs, and, I still do that, but I don't do that as much anymore because after real estate, you get tired of being a landlord or tenants or even property managers. Even if you own real estate and you have property managers, your property managers are a pain in the ass. Right? Yeah. So now I do more lending. I lend people money to buy the things that they want to buy, primarily houses. So like if you need to borrow money to buy a house, I will loan you the money, and again, based on the terms and the conditions of all of that. And so the reason people are wanting to borrow money from me and not a bank is because a lot of times people can't get the loan from the bank or they don't want to go through the hassle. The heartache. I call it the proctology exam of being approved.
Sometimes you can over leverage yourself too, like with the bank. You know how they do like the debt to income ratio and stuff like that. I remember I was talking with Chris Noggle, and he was saying that he was like the bank basically like froze his lines of credit and stuff like that just because they didn't know at the time he was over leveraged. Yeah, they didn't know he was over leveraged at the time. But then when he came back for like another property, that's when they started to like look back at all the other stuff and they're like, man, you're over leveraged, and they actually like pretty much messed up his deals because he wasn't able to stay liquid. And that's one big thing from it. So I got to touch on the fact, because this is a better investment channel, I got to touch on the fact. So you said you have gold and silver. So I'm big on gold and silver as well. And I think that it is a part of, I think gold and silver is real money, right? As Robert Kiyosaki would call it, God's money. Yeah. It was here before the roaches. It was here before, us. And so from there, it was something that was created when our Earth was created in terms of the planet that we live on. So it's something that can't be like manipulated or messed with in terms of like how we know the U.S. dollar and other currencies are messed with as well. Sure. So you own some gold and silver, which you say you're just too lazy to sell it.
So it looks like I got a buyer.
Yeah, exactly. Right. That's what I'm saying. I'm big on gold and silver. And I advocate for people. I tell people is that you need to have some assets outside of the system itself, because the system, even our policies are not an investment by nature in terms of it being a guaranteed contract, right?
Yeah, right.
That's why you're taking
policy is not an investment, because the definition of an investment is something that can go up and down and can go down. The policy can never lose value, can never go down. It can only increase
Exactly.
value.
Now, catch-22 to that is, can the dollars in your policy devalue?
Well, the thing that you're doing is you're using your good dollars today and you're paying back with dollars that are going to be weaker in the future.
Correct.
Because, okay, the question to ask is a dollar worth more today or in the future? And the answer is it's always worth more today. Because all you got to do is think about how many candy bars you could buy 25 years ago for $1, how many you can buy today. So essentially, we're doing, the thing we're doing is we're using our good dollars today and paying them back with weaker dollars in the future. Totally different than what a 401k IRA qualified plan teaches. They want your good dollars today, and they want to pay you back with non-guaranteed weaker dollars in the future. So totally different paradigm shift.
So we're kind of like giving them our money, and then they do the banking on us instead of us doing our own banking and using other people's money to become wealthier.
So who's the largest purchasers of whole life insurance
Banks.
in a mutual company?
Banks.
Yeah. Conventional banks. They've even quadrupled the amount that they've purchased since 2014, the last 10 years. So why are banks buying all this whole life insurance in mutual companies that pay dividends? Is it because they're stupid, or they know something the rest of us don't know?
Yeah, I think they know something we don't know. And more importantly, they've discovered different banking mechanisms that they can use, and that's something that modern day times is just now with like people like myself, people like you, we're kind of exposing that and helping the everyday individual understand like, hey, did you know you can do the same exact thing? It might be done in a different way, but you can do the same exact thing. And so even like with cryptocurrency, why I own cryptocurrency, I am in cryptocurrency. Why I own cryptocurrency is because once again,
I am not his mentor, ladies and gentlemen. He said there was no.
It's outside the system, and what's crazy is here's my prediction. By the end of 2024, you will not only probably own more gold or silver, you're probably going to be getting into crypto as well. I'm telling you, watch.
Yeah. Well, so anyway, we'll see. Let's come back in a year and see if that. True.
We'll see. And we're gonna come back and we're gonna see, because I think what's gonna happen is it's an investment. It is speculative. Things can go up and down, and that's the difference from our policy. So I always try to separate that for people, is that, hey, the policy is not the investment. Like even like you were saying how you do real estate, before you did the real estate deals, you went and put the money in the policy, then you lent out from your policy.
You put the money in the policy first, and then you go make the investment.
Exactly. So like, yeah.
And then again, I'm not saying gold and silver is bad. I'm not saying crypto is bad. I'm not saying stocks and bonds are bad. I just don't own any, and I'm not going to own any, right? Because I want total control of my money, and I don't want the risk factor. Look, I've owned gold and silver before I even knew about infinite banking. I think I started buying it in 2004 or 2005. I never started my infinite banking policy until 2008. Had I known about infinite banking in 2008, so I wouldn't have bought gold and silver. I want you to go back, and I want you to look, and anybody can do this at home. I want you to go back, and I want you to look and see, so go back to 2005, 2006, somewhere around that time, and I want you to see how much gold was at that time and how much it is now. Look at silver. How much was it then? How much is it now? Okay? See, here's the problem with gold. And so people think, well, if the dollar crashes, we're gonna have to use gold, right? Well, I got some gold bars, I got some gold coins, I got these big round gold things, whatever they are. If I want to go buy a loaf of bread and I want to pay that with a gold bar, how are they going to give me change? Right?
Yeah, correct.
How are they going to give me change for that gold bar that I have to give them? And all that gold and silver that I have, which I wish I didn't have, guess what it's been doing for the last 15? Oh no, I said 2005.
Yeah, but it's
so the last 18 years, close to 20 years, that gold and silver has been doing what? It's sitting. Yeah. It's stagnant. It's not moving.
Yeah, it's not a cash flow asset.
Motion of money and being able to keep that money in motion. So everything that I teach about you want to keep the money in motion, I am violating by owning gold and silver. I'm violating that principle because I'm letting something sit and it's stagnant.
Okay. Yeah. That is a heck of a point of view. As and then too, what I think is that in terms of like people, I think people have that misconception as well. Like, oh, we'll have to use gold and silver if the dollar crashes. The reason my purpose for gold and silver is because I think that the newer currencies, I don't think that the game will change. I think the rules will. And so I think we'll still have currencies. And that's the thing, is that at one point in time, like based on the Constitution, you couldn't use paper money. Only gold and silver was being used and transacted in. Now we have it to where we're using paper currencies, and I think what's going to happen is we'll have government digital currencies that's backed by real hard assets like gold, silver. And so I think right now that because you're doing the same thing basically, but you diversify into stuff that you feel more comfortable with. So like real estate, right? Diversifying into real estate is still helping build your net worth. It's an investment, but it's something that's been proven to be very steady. It has a continual trajectory of going up, and it's a way to diversify yourself out of just only having dollars. You own real estate, you own other things, but it's something that you know about. And that's the thing I tell anybody, like the best investment is what you think you either feel the most comfortable with or you know the most about. So I don't think you should do anything with your dollars that you don't know a lot about. And so I know that's one big thing is that definitely gold, silver, and different things, depending on what crypto you're investing into. If you're not doing like what's called yield farming or staking, you're not the dollars that you've put into that asset are just sitting there. They're not flowing and growing like you said, right? Unless the price goes up. So with your policies is that you have liquidity and you have that flow, right? You got that motion where I put my dollars in, they're going to grow with interest. Then I can take loans and go make some investments if I want to, but I have that growth already happening, and I have the flow and the law of motion when it comes to money. Now, what I had to ask about the policy loans, guys, and if you haven't caught the first episode that me and Brent did, make sure you subscribe to the channel, leave a like, comment, let us know what we can help you out with, and more importantly, go check out that first video. So kind of following up, I know you got a call. What is your reason behind why you personally, Jonah was telling me this, he was like, well, Brent, he does something a little bit different, and infinite banking is infinite, right? Yeah. In different ways. Why do you, when you take your loans, why do you only pay the interest on your loans instead of paying them back? Is it based on something that has to do with net worth and what you're valued at right now versus like when you first started? Like when you first started, I know you were paying back loans, right?
Yes.
Okay. Yes. So what changed over time?
Well, it depends. I mean, if I have no use for the money, I've always paid back loans.
Okay.
If I have no use for the money, so I believe everybody needs to play honest banker with themselves, and they need to pay themselves back with interest. The same way if you borrow money from a conventional bank, you're going to pay them back with interest. So treat your money the same way. Don't treat a bank's money any differently than your money. If you do, you're saying your money is not as valuable as the bank's money. So treat your money the same way. So if I borrow money from the policy and I have, say, 10 third-party debts that I have to pay, I'm never going to pay back that policy loan until I get those debts paid off. So I'm going to continue to use the money. I'm going to continue to keep that in motion. I'm going to continue to keep all of the money in motion, and I'm not going to pay back the policy loan. Because if I pay back the policy loan, all I'm going to do is I'm going to send that money back to the insurance company, and then I'm going to request it the next day for something new.
Exactly.
So I'm avoiding pain. So I am avoiding playing mental gymnastics with the administrators of the insurance company. Now, if I have no use for the money, and my definition of no use for the money is if I don't need the money for the next 90 days, then I'll send that money back to the policy. I'll pay back the policy loan. every year, annually, I pay back my policy loan interest. So whatever the interest is, I always pay that back. Now, the insurance company doesn't require you to do that, but you should do it, because when you do it, it allows you to have more money to use. And if you don't do it, that interest just compounds, and you don't want that. So make it a habit to always pay back the interest portion of your policy loans. So as I've kind of gotten, like, again, as I've done this now for years, and the wealth continues to build and build and build, now what I do is I want to borrow. I want to borrow as much money from my policy as I possibly can. As a matter of fact, my wife will ask me every few months. She'll say, Brent, how much cash value do we have in our life insurance policies? And if I tell her a number that's too big, she gets a little angry. She says, no, I don't want that cash value in the life policies. I want my green men working. That's what she calls money, is green men. I don't want them just hanging around, doing nothing, being lazy, eating potato chips on the couch, watching TV. If anybody's going to eat potato chips and be lazy on the couch and watch TV, it's going to be her and not her green men. Much like the reason I don't want to have gold and silver, because it's lazy. It's doing nothing. It's just sitting there. It's sitting there stagnant, not doing anything. The only thing it does is it goes up and down based on the gold chart and the silver chart. That's all it does. It goes up and down. You wake up. I don't even know what gold is now. It's $1,200 an ounce. Next day, it's $1,300. Then it's $1,100.
Well, it's sitting at about $1,900 right now.
$1,900, whatever it is.
What was the price when you first started buying?
I don't even remember. Right? That's why I say go look and see what it was in 2005 or 2006. But let's just hypothetically say that back at the time that I bought gold 18 years ago, that it was $1,000 an ounce.
Okay.
Let's say today it's $2,000 an ounce. So I had to have that $1,000 tied up, didn't I? I had that tied up for all of that time. How much could I have made on that $1,000, right?
Yeah.
Because now, and again, for years, I have not loaned any money out at below 10% interest. So if I'm going to make 10% interest on my money, and if I have $1,000, okay, that means guess what I would have next year? $1,100.
Yeah.
The next year I would have $1,230. The next year $1,370. So I have lost money, even though the gold and silver possibly has gone up twice the value, which it has, and it hasn't doubled. So all of that time has been where it's just been sitting there stagnant. Where now I'll go out and I'll loan money at 12%, 14%, 16%. And because as the interest rates go up, as the environments go up in interest, then I'm getting paid more as a lender. So in the lower interest rate environment, I was making 10%. In the higher interest rate environment, I'm making 14 to 16%. So
what's crazy is I actually pulled this up while you were talking. You said in 2005 it was? 2004 or 5?
2004.
It was the price was $445. It was $444.99. So $445 is from then it has now done a 3x.
So,
but the opportunity cost, like you were saying,
2006. What was it in 06?
Let's see here. The opportunity cost, like you were saying though, because it was 604 in 2006. So the opportunity cost, and that's the bigger picture that I'm painting too. And I tell people that's why I diversify in the way I do. And I tell people, most people, they see the side of like what we were talking about, like they only see upside potential. They don't understand the opportunity cost of not being liquid.
Right.
And that's why I tell people, hey, you need to do everything kind of through the banking system, right? And you want to have that banking system put in place, because is crypto like a form of having your own banking system? Sure. Is owning gold and silver going to be an asset outside of the system and something that you can hold and see, whatever? Sure. But the opportunity cost of you owning something that only can appreciate in value versus having something that can appreciate in value and it has cash flow. So it has liquidity to it.
That's the key. Cash flow. See, that gold that I bought or that silver that I bought, it has no cash flow. If I lend money to someone and I get paid 10% interest, that's cash flow.
Correct.
It's coming in. So those interest payments are coming in every single month, and I'm able to put that money into other stuff. And then also the reason that I'm getting out of real estate, really, I'm selling most all of my properties is because if just there's a time and it happens when you have tenants and that property is not rented, you have the downtime, but you still have all the carrying
all the overhead expenses,
well.
Exactly, repairs, different things like that, the taxes. So to kind of wrap things up, and thanks for some good insights here. To sum up the question that I did ask you earlier, you were saying that at first, of course, you want to be a good banker and you were focused on paying yourself back. And I think that was, not to put words in your mouth, I think that's because at the time you were still on your journey of where you are now, right? So you definitely want to be an honest banker and so on and so forth. And then kind of when you reached a certain point, it's like, okay, I have access cash and I have it to where now, I can choose to take loans, and the opportunity cost of me taking that loan and making this investment versus keeping that money there so I don't have to pay the interest on it is not worth it. So like, for an example, you take out $100,000, 5%, that's $5,000, right? But if you take out $100,000 to go make 20%, that's a $15,000 difference.
Well, and that's exactly what I did.
Exactly.
That's exactly what I do. So I'll take a loan all day long at 5 or 6% interest and go out and put it in something that's making 12, 14, or 16%. Because here's what's going on in the policy, the growth is all the money is still growing. So if I take 100,000 out of the policy, I never took the 100,000 out. So that 100,000 is still in the policy, growing and compounding in that guaranteed tax.
Yeah. So you took your 100,000 from the insurance company
twice, and I'm continuing to make money on top of my money. So I'm not making money just in one place. I'm making it in two places. I'm making it with the growth of the policy, and I'm making it with the loan that I did, and the borrower's paying me, the lender, back. Now, let's go with one step just a bit deeper on this. I'm not saying don't pay back your policy loans. That's not what I'm saying at all. As a matter of fact, you need to be disciplined with this structure. And if you're not a disciplined person financially, you definitely want to pay back all your policy loans on a payment schedule. Now, I don't know how disciplined you are as an audience. I meet people all day long that they're extremely disciplined and this would work well for them. And then I meet other people that actually, and those people think just because they have checks left, there's still money in the bank. Those people are not disciplined at all. So it depends on where you're at in your financial life. So what I would say in the beginning, especially when you borrow money from your policy, remember, you're not really taking it from your policy, it's coming from the general fund of the insurance company. Set up a payment structure. If you borrow, for example, in my presentation, I show how a person borrows $25,000 to buy a car, and they pay themselves back $500 a month or $6,000 a year for 5 years. They pay that money back. So you borrow 25 and you pay back 30. Borrow 25 and pay back 30, which is very similar. And actually, if you break down the numbers, that's about a 6% interest rate, 6.2, 6.3.
In most cases, that's cheaper than if you went through traditional banking.
Yeah. So, but no, I'm saying exactly. But the thing I'm saying is that this is what you do. You just take the money and you pay yourself back on the terms that you decide to pay yourself back on.
And just be a good banker to make sure.
And if you don't want to pay $500 a month, $6,000 a year, pay $400 a month, $5,000 a year. If you want to pay more, pay more. So you get to control the banking function of your life, and that's the beautiful thing.
Yeah, so a big things you touched on here. So we heard you talk about today, you were talking about liquidity, having cash flow, having more control, what we can do with our own bank.
It's all about control.
Yeah.
It all comes back to control.
Safe growth, okay? We got safe, so we got control, liquidity, safety, which should probably be first and foremost is we have safety, being that it's not going to go in reverse, it's only going to go up and appreciate. And a fourth thing that you really touched on is actually making money lending other people's money.
Yeah.
Because when you put your money into the policy, it's not going anywhere. You lend out from the policy the insurance company's money. Yeah. And then you go make a higher return than what the insurance company lent that money to you for.
Well, can I give a quick example of what I just did here?
Yeah, like please. That's what we need. We need a breakdown. Let's get it.
So anyway, the house that I live in, my primary house, the house was appraised at like $2.2 million. I went to the bank and I said, Mr. Banker, how much money will you lend me on this house? What's the max that you'll lend me? They said, we'll loan you $1,560,000. Let's just call it 1.5. Mm-hmm. What's the best interest rate that I can get on the terms? And back at that time, 18 months ago, we'll get you 2.75%. It was right. I can't remember if it's 2.75 or 2.82. It was under 3%.
On 1.5?
So let's just call it 3%. So the bank gives me $1.5 million, 3% interest only loan. Interest only for 10 years. Okay? So that payment is like $3,700 a month. So every single month I pay on that 1.5 million, I pay 37, I think it's 3,700. Let's just call it $4,000. I like to underpromise and overdeliver. So every month I pay $4,000. But guess what I did with that 1.5 million? I went out and I put it into a guaranteed investment vehicle where I was the lender, collateralized real estate, and I loaned that money out at 16% interest. Now let's just call it 15%. Mm-hmm. So 15% interest, 1.5 million. Do you know how much interest that is a month? It's $150,000. Okay, on like $1.5 million at 15%. At 10%,
it's 150, right?
No, at 10%, it would be $150,000 a year.
At 10%.
At 15%, it's $225,000 a year. So $225,000 a year is what I'm bringing in on that loan. And my interest rate that I'm paying at the 3% or the $4,000 a month is $48,000 a year. So do I care if I'm paying $48,000 a year in interest if I've got $225,000 a year coming in?
Yeah, no, definitely.
Not
it's
at all.
Positive arbitrage. So just a quick breakdown. You went lent basically HELOC lent against the equity of that property. You then went and you put that into the policy, or you went and did more?
Yeah, well, yeah, all the money goes into the policy, but then I have lots of policies, multiple policies that have cash value
Got
in
you.
them.
So you put into your banking system.
Yes.
Then you lent out of the banking system to then do more lending.
Yeah.
At a higher at a higher interest rate than what you were being charged on the original loan that you took from the bank.
Yeah. Let's go one step deeper because you just mentioned it.
Yeah,
I was trying to keep it really simple. I'm paying $4,000 a month, or basically per year, I'm paying like $48,000 to borrow that money. I have $225 coming in, so $225. Let's call it minus 50. $225 minus 50 is $175,000 more that's coming in than what's going out. I also get to deduct the policy loan interest off of my taxes that I'm paying to the bank. Okay.
Yes.
Now, guess what else happens to the 1.5 million? Where's the money at? As you just said, it's in my policy. What is the guaranteed growth in my policy plus dividends? It's greater than 4%. So not only am I making the loan that's coming back to me 15% interest, I'm also making that guaranteed tax-free growth rate in the policy, which is greater than 4%. So so that's above and beyond the $225,000 because the 1.5 million never left my policy.
Yeah. It's two different ways here where you're making, actually three. You're getting interest paid on the premiums that you put into the policy. You're getting interest paid to you on the money that you lend out to other people for whatever the deals that they're going to do, and then they pay you back with interest. And you get the interest payments when you overpay if you were to pay yourself back. So if you chose to make that decision where, I took out $150,000 out of my policy, I'm going to put back 200,000. The extra 50,000 that you put back is going to go into premiums, which means now you just increase your net worth even more.
Right. And not only does it go into premium, it goes into what we call paid up additions rider, which actually almost all the paid up additions rider money that you put back into the policy is yours to use immediately. My definition of immediately is in 30 days. It increases your cash value, it increases your loan availability, and it increases your death benefit.
Yeah, so from this conversation, if you are a thousandaire, you can become a millionaire. If you're a millionaire, you can become a multimillionaire. If you're a multimillionaire, you can become a billionaire. This was great, man. I appreciate it, Brent, you coming on. I know I learned a lot, and I'm going to start exercising some more stuff on my end and leveraging some different opportunities myself. So I definitely appreciate you coming on, man. Once again,
Thanks for having me, man. Let's do part 3.
Yeah, of course. Yeah, he has to go get on his own private plane here to leave pretty soon here. So that I know you introduced to me another thing. I didn't know that our airport had another side to it.
Yeah,
so today I learned something new. I only been on the regular side. I ain't been on the other side yet. But yeah, man, I appreciate you coming on. Thank you guys for tuning in. Make sure you like, subscribe, leave a comment, let us know how we can help you out. Share this with somebody else that could use this information. And until next time, better investments equals a better future. And I'll see you guys in the next video.
Take care.